Yeah. If you want to start or scale your property development business to 8 figures and beyond, then you're in the right place. This is the Property Experts Podcast with Ben Richards and Jack Jiggins, two serial entrepreneurs bringing weekly insights from our award-winning businesses. In these podcasts, you'll learn how we found, funded and delivered over £80 million worth of property in the last 6 years, with templates you can use, deal analysis and deep dive discussions that will help you build your businesses successfully. We hope you'll enjoy. Hello. And welcome to this week's episode of the Property Experts Podcast with me, Ben Richards, and Jack Jiggins. We have got a very, very busy agenda today, but the main focus of this week is on strategies, property strategies. Every single strategy that you can think of, we are going to discuss in detail where we've done them, how you can do them, things to look out for, risks, mitigations, all that type of stuff. So if you're interested in flips, HMOs, buy-to-let, ground up, land promotions, commercial conversions, you are in for a treat because we're going to run through them all. So stay tuned, get your questions in down below. We love questions on this podcast. So even if you aren't listening live, comments will still get read, and we will often bring them into the Q&A at the end of the episode next week or the week after or whenever. So don't think that just because you're not watching it live, you can't ask questions, because you can, because we will bring them up in future episodes. So property strategies is the top of the agenda for the 30th of January 2026. We're going to be then talking about professionalizing the property industry and debunking some marketing jargon from the gurus out there. Going to be chatting a little bit about Aura architecture and how they can help you with your developments, how we structure deals with investors. That's from large developments all the way down to sort of small HMOs and flips, and how we structure our investment with investment partners using equity, using debt, all of those good things that we've been asked a lot in terms of how we do that. We are refinancing today at Long Hanborough, and we'll be giving a very quick overview of the doctor's surgery to 5 flats that we've converted there. I'm going to Dubai, so I'm going to be trying to rope a few things in terms of meetings and a Q&A at the end, as always. So get your questions in now, ready for a jam-packed episode. So welcome. Got a question already. There we go. Amazing. Thanks, Murad. Thanks for tuning in again. But before we get into that, for those that don't tune in regularly, we are XP Property. That is one of our main businesses. We operate numerous businesses in the design and construction and property sphere. But XP Property is our development and investment business, and our aim is to deliver 1,000 homes and £1 billion in property in the UK. And we do that by collaborating with trusted investors. We have got numerous investments that are still available or open, or new investments coming through, new opportunities, ranging from £200,000 investments all the way up to £5 million restructuring of portfolios, new equity deals into commercial conversions and land deals. So whatever your risk appetite, whatever your Jack, you're sharing your screen, whatever you are looking to do in UK real estate, we would love to speak to you and see if we can help you deploy some of that capital. We are award-winning property developers, and we would love to work with you, so do get in touch. Welcome. So property strategies, we've got a long list on the screen: ground up development, conversions, HMOs, serviced accommodation, social housing, buy-to-lets, options, land promotions, service-based businesses in the property industry. And we are going to go through them one by one, discussing the pros and cons. And again, if you feel like we've missed anything, drop your comments down below, and we can throw it in there as well.
Yeah, I just felt like we hadn't touched on all these we go on, jump on with energy and talk about all the things that we do, which is predominantly conversions, HMOs, social housing, but we don't actually talk about the different strategies, what the benefits are with the different strategies and what the negatives are. And the reason this really popped up is because, it's okay if you want to do something slightly different to someone else. And there's educational platforms out there that will push you into learning about every single one of them and spending another £8,000 on a commercial conversion course. But we would love our listeners to get their strategy together and then absorb as much free information as you can from YouTube. And then if you still feel like you need training, then go down the route, because there's a lot to think about. There's a lot to do. I was talking to someone about service accommodation this week. Actually, I was on someone else's podcast, and I just don't really like it. and I explain why. So I thought, why not go through everything one by one? We can share the pros and the cons, and then Ben and I can have a little bit of a dispute if we disagree on anything. And I'm sure there are more strategies, but these are by large the most. There's also a few others like auctions and trading, but we're not really in that game. I think there's some auctions and trading can fall into these strategies anyway. But should we get kicking with ground up?
Yep, cool.
Yeah, sorry, I went to share something in the future and it popped up immediately earlier. Ground up development. So this is new build housing. This is what the national home builders do. They take on swaths of land. You can obviously do smaller schemes. You can have a scheme as small as 1 unit. We have done that before. And going through the pros, typically houses sell better than flats. So one negative or con we have in commercial conversions is we're repurposing an existing building. And I believe that if you're an SME developer building a new build housing scheme, your sales should be better, the better part of the market. Equally to that, you can phase sites. So you may have heard us talk on this channel about sales rates. And what we mean by sales rates is if you launch 20 houses to the market in an area, you might not actually have 20 buyers, no matter how good those houses are. So you can slowly drip feed the product into the market, almost supply and demand is the kind of economic rule of that, so that you can get sales out the door as you go through. Doing that, you keep your leverage of finance quantum down because you're selling as you're delivering, and there's a lot more control. And I've actually heard land developers say, if we deliver half and sales aren't good, we'll stop building. So you have a little bit more control on delivery. As far as the commercial conversion goes, we've got to finish the whole site. And then we can really start selling units. Obviously, we can sell some off plan, and obviously we can practically complete on some others that have a communal space in a different area, but we really have to finish those units off to get them out the door. The build costs are extremely predictable once you are out the ground, and you've probably guessed what one of the cons is of ground up development. But once you have got to slab level or foundation level or even piling level, you can then have pretty predictable churnable costs to get out of the ground, because you're basically building a similar thing over and over again, and then it's down to spec, fixtures and fittings and equipment, M&E, etc., which you can budget for. So it's a lot more predictable as far as budgets go. Similar to commercial conversions, comparing it, you don't really know what you're dealing with until you're dealing with it. So that's kind of the ground element of commercial conversions. The pros: securing deals and pre-planning. It's a lot slower burn, I would say, in securing the deals. But if you have a really good build team, or you can build out for a low cost, this is a really good strategy to be adopting, because there's typically the biggest quantum of value is build. So in a commercial conversion, your purchase price might be greater than your build costs. So securing deals for people that have the competitive advantage of construction may find more deals. And if you secure these sites pre-planning, hopefully you'll also make some planning uplift on the site as well. As I said, housing is more desirable. People do want to live in houses. If you can make an affordable product, put it onto the market, you typically will have a better sales than a commercial conversion. Do you want to do cons, or should we alternate the strategies?
Yeah, you crack on with the cons. I'll do the next one.
Time frame, soft cost, planning and funding. So if you are trying to secure land deals pre-planning, I don't believe you can get in and get out of a new build site and planning within 5 years. So if you're trying to build a business and build a team and build a reputation, it's super, super, super slow burn. If you're buying something with consent, obviously that is going to be a lot quicker, because you have the site already consented. So I do think the delays in getting onto site and sort of breaking ground is a long time. You should expect in excess of 2 years to get on site if it's pre-planning. If it's post-planning, obviously quicker. Depending on the discharge conditions, you can get on site quicker. But if you are looking at pre-planning, which is where most of the uplift is, it does take a while. Next to that is connections and utilities. Depending on where this site is, you might be thinking it has great car access, but does it have access to various different services that you need to the site? We found services onto site super, 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 super slow. more complicated than it needs to be, and also quite expensive. So it's all well and good. We've actually had sites where we finished them and can't sell the units because the connections aren't all signed off. So not ideal. Coming on to the counter of the pro, ground risk. So you don't obviously really know what you're dealing with in the ground. There is a site in Henley-on-Thames, which is where I live, for 100 units, which Taylor Wimpey bought 7 years ago. They obviously didn't do the DD up front that they needed to do, and found out that there's basically almost like a trickle stream underneath the site that basically offsets a lot of the water down to the river. And they paid £18 million for that site 7 years ago, and they still haven't got a proceedable plan that they can proceed with and build out this site. This is the epitome of ground risk for new build sites, because they are 7 years in finance costs servicing £18 million, and they still haven't broken ground. So huge risk in the ground. If you can get out of the ground, it's predictable, but in the ground, it's less predictable than, for an example, a well-built commercial conversion that you might be able to do. Cons, I know I talked about sales and phasing, that houses are more popular and phasing's more popular. When you get in and out of a land deal like this, a ground up land deal, you might be in a completely different market to what you are when you start the project. So you could be 3 or 4 years delivering a scheme. Commercial conversion is a lot quicker. You can get in and out of a scheme and get them on the market within 12 months. Therefore, the sales duration risk that you're taking is very, very different. So there is an element of sales risk from a macro or micro element from that particular area. But they're like the general swaths. Obviously, you've got to think about, in ground up schemes, how you do the capital raising and the funding. Funding is fairly straightforward. There's a lot of funding options out there now to be able to approach a bank and get something drawn down in arrears. One thing I would say that compares commercial conversions to land is you typically have a lower capex cost to get onto land, because the purchase price of the land is typically a lower ratio of a building. But you need to typically top that up to make sure your loan to values, loan to cost, and loan to gross development value stays under the threshold. So typically with land, it's a lump of money at the beginning, but then also a sort of drawn out lump throughout the project. Whereas commercial conversion, the big lump is always at the beginning. To buy the building is typically the biggest expense. And then you can typically draw down the facility and stay within the loan to value perimeters that you need to. Another potential con for ground up is not a lot of lenders like lending money to people that haven't already done it before. So you do have to bring in the right team, have the right track record. And it's not that easy to just walk into a lender or a brokerage and actually get the funding. So hopefully that's a whistle stop tour. Takes a while, good product to be delivering, might struggle with funding if you haven't got experience. We would love to be doing more land stuff, but it's just not leaning into our competitive advantage, and we'll come into that more when we get into the construction phase.
Yeah, it's just touching on that, and we'll come on to more like land promotions later. But obviously, sort of some of the things that Jack's mentioned are going to depend on how big the scheme that you're talking about in terms of the ground up. You could be building blocks of flats to the ground up. We could be building houses, and obviously there's different nuances with each. One thing that I was going to say with sort of ground up new build housing, and it is relevant to both, to be fair, flats and housing, but we haven't mentioned affordable housing. When you get over those 10 units and you've got a 10 unit scheme plus, you are going to be hit with affordable housing contributions, and that has Section 106 obligations. That has a really serious impact on the bottom line for you, effectively, because let's say it's 40% of your site needs to be affordable housing. That 40% is effectively being sold at almost cost. So you're not making any margin on those 40%. And you're basically hoping that the rest of the private sales on the scheme are sort of counteracting that and giving you the margin that you need overall. There's a lot that can be said about that in terms of viability assessments and reducing the affordable contributions and quantum of affordable on the site. That's a whole different topic in itself. But when you've got larger new build ground up schemes that are above 10 units, you are going to be battling with that affordable housing contribution. And there's a real, I think, kind of dead zone between probably 10 units and 25 units, where it can be very, very difficult to make that that market stack up when you start factoring in affordable housing? And that's why the government are thinking about sort of introducing this kind of medium-sized development threshold that's sort of 10 to 49 units that has different different criteria from a affordable housing and BNG obligation and all this sort of stuff. So we'll have to watch this space for sort of how that progresses with the government and the NPPF and strategies that they bring out that way. But yeah, good insight into ground up. On to commercial conversions, which is something that I'd say we specialised in over the last sort of 6-7 years. If you really want to dig into some detail around the intricacies of commercial conversions, season 3, episode 46 is a banger. We basically go through the whole process you need to know about for commercial conversions from start to finish. And Aura Architecture on their website has a guide you can download for specifically around commercial conversions and ways to add value using full planning as well as permitted development, how to navigate that process, key risks, key things to look out for. So go down to the website and download that as well. The pros of commercial conversions or any conversion is generally speed. You're not, unlike ground up and full planning schemes, you can utilize permitted development, for example, to get on site. You can move faster because ultimately you're not having to dig in the ground, which often swallows up a lot of budget and time. You can crack on straight away with a building that is already in existence and already a shell for you to crack on with. Ultimately, it's often more of a fit out. So again, you're not necessarily dealing with external walls, new roofs, new foundations, new fabric. You're working mostly on the inside of a building where it becomes more of a fit out type specialism as opposed to new build. Cheaper build typically. Ultimately, we're building out our commercial conversions at 160 a square foot in our areas. New builds, you might be looking at more like 230, 240, 250 a square foot, depending on the areas that you focus on. Obviously, we're down in the southeast, so things are going to be more expensive than necessarily up north. But yeah, cheaper build compared to new build, and it's faster with the planning process. So we mentioned permitted development. Often you can utilize Class MA, Class G, various other permitted development rights to convert existing buildings far easier than going through the full planning permission process that can take months and months and months, depending on the size of project and complications of project that you're working on. So there's a lot of the pros of dealing with commercial conversions. We like them. We like being on fast and on site fast and out faster. But the cons are that they can still be capital intensive. That's the nature of all development fundamentally. So it's not necessarily just a con for commercial conversions. They are popular nowadays, so competition is obviously a lot harder. This particular site that we're showing on screen, which is the old Maltings in Abingdon, was, I think Jack saw like 4 or 5 London-based developers on the open days. That's who we're competing and fighting for the projects against. And the more popular it becomes, the more competition there is in the space. And the sharper you have to be on your analysis, your costs to win the opportunities. Connections and utilities are massive, whether it's new build or existing. But with existing conversions, it's you're not starting from scratch. Whereas a new build, you're obviously, there's nothing on site as it stands, so you're having to bring in new services. Whereas with the existing, you are often repurposing existing electrical supplies, for example, into a new BNO network or adapting what's on site to suit your new proposals. And that obviously comes with a lot of complications, a lot of costs. And with conversion projects, once you're inside with the utilities, you've then got to think about how you're then serving the conversion, the development in terms of service route risers, complications around fire protection and lobbies and tracking the services around the site, which can have a lot of complications when you're working with existing buildings. And then the last point is working with existing buildings. Sometimes you don't know what's underneath the plasterboard or hiding behind some boxing until you do that strip out work, until you do that investigation. It's difficult to know. That's why contingencies are key. 10-15% contingency depending on whether it's a listed building or a simple 1980s office fit out. For example, our contingency in Tame, where it's a 1980s building that's very solid construction, cavity wall, masonry walls, precast concrete floors, big wide spans of open spaces. That is way easier to fit out and convert than a 1900s Victorian property that is falling apart, subsiding, hidden cracks behind plasterboard, etc. So those are all the things that sometimes when you make an offer on these types of sites, you can't necessarily see straight away. So until you've done that strip out and investigation work, you might have to stump up some fees that you didn't expect to pay for due to sort of structural works and remediation works and things like that. So yeah, pros and cons of conversions. We are definitely specialists in the space. So if you've got any questions, then drop them down below. Before I actually jump,
sure you're not a guru in this space, Ben?
Pretty sure we are, actually. Yeah, we should probably start pushing that. Good chance to bring in Murad's question, which he asked a while ago with regards to percentage. How much have construction costs inflated since pre-COVID? Yeah, I think they're probably 30-35%, more. During that COVID period, things did inflate 25-30%. It made things extremely costly, and it's tempered in terms of it's sort of flattened out, and it's rising at a much slower rate. But during that time frame, it was insane. But I think people are now adjusting to that new level. But yeah, I think 30-35% since pre-COVID. Cool, Andrew, thanks for the question. We'll come on to that in a minute. But Jack's going to talk through
HMOs. So HMOs, for those that you don't know, are shared housing, co-living houses of multiple occupancies. So this is just generalized. I'm not talking about under 6 beds or over 7 beds. This is just fairly general. And I think the pros are it's scalable, recurring, fairly simple construction. If you're sitting below 6 beds, you don't need to change the fabric of the building because it's not a sui gen build in a lot of locations. Some people I know in some locations are being forced to upgrade the fabric of the building to new building regs because of the change of use from C3 to sui generis. But typically where we are, it's a fairly straightforward fit out. The cash flow is typically pretty good. The beauty that I love of HMOs compared to developments is, let's say we're focusing on a target return on cash annualized for 50% of the profit for an investor of 20%. The beauty of HMOs is recurring. You don't need to find the asset. You don't need to find the money. You don't need to take the risk. You don't need to deliver it. You don't need to take the sales risk over and over again. Obviously, if you're doing that over and over again, you will get some deals that do not work as well as you would have hoped. Whereas HMOs is a recurring income play. And that's what I love about it. And it's a high cash flow recurring income play. So I actually really like HMOs. We're talking at the end of this section about strategies, about what strategies can you merge together and do dual strategies that complement each other. And I'll come on to that a little bit later on. But the beauty of the HMO portfolio is you're building a portfolio of assets, benefiting from the capital appreciation, changing the use so that you're essentially capitalizing on higher cash flow. And that is fundamentally what Central Suites is. And actually, like a development company is very sporadic with cash flow, HMO portfolios are quite predictable. That rent comes in and you can make more predictions on growth, change, scaling, hiring staff, etc. The downsides, I would say, the first port of call is tenants. Now, the way that I would explain this is we're not saying that tenants are a complete nightmare blanket, because we have a lot of amazing tenants, but we're in the commercial business and they're in typically the emotional decision. So it's sometimes difficult balancing that. And we like to think we're good landlords. We like to think we have a good response rate. We like to think we have a good product. And we like to think we're good with dealing with problems. But there comes a time where just by factor of having over 150 tenants, you do get problems where they're not happy with a fellow tenant, or it wasn't what they had expected, or something's potentially, Wi-Fi's gone down, hot water's broken, whatever it may be. It is starting to get more into the noisier business because you have recurring revenue tenants And that is just the fact. And a lot of people have struggled with tenants, especially with the renters' right reform, to make sure that they're sort of buttoned down and controlling that as best they can. I'm quite fortunate that my brother and the lettings team deal with the tenants, so I kind of deal with the bits that I prefer. But tenants is definitely one of the largest downsides dealing with the tenants. Then you've got compliance. I would say that HMOs have to be very compliant. The reason why that's in there is because I don't think service accommodation has any compliance or regulation, whereas HMOs does. And that could be a pro and a con, kind of builds up the barrier for entry for people to come into the market and learn about it and make the mistakes, costly mistakes typically. But for us, we're getting very fluid with what we need to do, how we need to finish it. And we can very much cookie cutter our product into different assets. Third one is asset class and perspective. So we've got HMOs in the town we live in, and we've got HMOs across Oxfordshire, and we've actually had some neighbours that just outright refuse that they want a HMO within their estate or in their neighbourhood. And it just doesn't have a great reputation. You know, if you're building luxury homes or you're building luxury flats or whatever you're doing, you typically have a slightly better reputation. Yes, there is an inconvenience during delivery, but it's sometimes a bit frustrating when you've got a HMO, everyone hates you. We have just secured a sui generis planning application for our 7-bed, and there's only 40 houses on the road, and we had over 30 complaints. So your neighbours just dislike the product, even though if they gave it a chance, let it run, let it operate, and complained by, retrospectively, that would be okay, because there's obviously a problem there. But we haven't really had that situation. In actual fact, we've never had a neighbour complain specifically about our tenants and the product that we're delivering. So that's definitely a con. And then valuation risk. With bricks and mortar valuations and yield valuations, I find that there's always quite a lot hanging on the valuation. We're just refinancing a 6-bed at the moment, and the valuations is poor, like really poor. We weren't really left with much choice because our development facility is coming to an end, so we just had to swallow the lower valuation. Yes, the pro to that is your mortgage is smaller and your cash flow is better, but I'd much rather recoup the capital and go again, which is the whole point of the HMO portfolio and business. One of the main reasons I got into business and property is I was actually working on site, and I read a book. I think it might have been Rich Dad Poor Dad, but there's a phrase in it which is earn money while you sleep. And the way I see that HMOs are and buy-to-lets are is you're earning money while other people sleep, which is when you sleep as well. So that's what I love about the business model. It's recurring income. You're providing an essential service, so it's always going to be in demand if the product's right in the right place and you're not saturated. I think one of the biggest risks for HMO delivery is actually being in an area that is saturated by other HMO landlords. But if you're in an area where there is demand and you can build a cute little business out of that, I think it's an amazing strategy. And we'll talk about collaborating it with other strategies later.
Nice. Cool. Service accommodation. Oh, I get stuck with this one. Similar to you. No, I was just similar to you. As of Thursday night, I was at the Central London Property Network and on the panel talking about strategies for 2026. And the lady next to me said that their strategy for 2026 is going to be service accommodation. And I couldn't think of anything worse. Ultimately, yes, the pros of it are cash flow can be great. It's high yielding. You might get £3,000 on a £3,000 a month on a flat as opposed to 1,200 quid a month on a flat. But the cons of that are that it's extremely noisy, and to operate it, to manage the cleaning, to manage the tenancies, the ins and outs can be extremely extremely noisy. Ultimately, with service accommodation, I think you have to operate it as a business. This is not something, in my opinion, that is a sort of as passive as property may be. It's not a passive strategy. It is a very, very noisy business. So yeah, cash flow is great, but it's noisy and operational. Speed, it's something you can turn around very quickly. When you look at kind of the gurus and the marketing, property education platforms out there, the reason that they are promoting service accommodation is that you can be in and out. The speed is there. You can do a rent to rent on a flat or a house. You can turn it around very quickly by just throwing some nice furniture in there, getting it listed, and that delta between kind of what you're offering on a guaranteed rent versus what you're getting in rental income can be very lucrative. But ultimately it comes with the noise, so you've got to be prepared for that. I think people come into the service accommodation space thinking, oh, it's very lucrative, and not really understanding the business model behind it and how difficult it can be. Deal flows there, you basically, it's most assets will fit this model. So from a deal flow perspective, you don't have to look far to find something that works, which is obviously a massive pro. And the capex at the start of those types of strategies can be very, very low. So again, if you're starting out in property, this is why you get a lot of the property education platforms saying that service accommodation, rent to SA, that type of model can be very good in terms of you've got no money, you've got time, you want something to move fast and you want it to be high yielding. Great, service accommodation can be amazing for that. You don't have to put in much money yourself. The return on investment can be very lucrative. Cons are, I think you are flirting around the edges of regulations that I see a lot of people pushing service accommodation and not necessarily fully understanding that you could be operating under mortgage fraud. You could be operating in a planning space whereby you don't have the correct planning approval for effectively C1 use. C1 is hotels, short lets, all that is a formal property use class. And most people operate service accommodation as a C3 dwelling, which is a different use class entirely. There are, I don't know if they brought it in, I don't think they have yet, but there was talk about moving from a C1 to a C3 use class, interchangeably, to make this more of a robust strategy. I think they were introducing a new one actually called C5, and that was what it was for, but I can't remember the exact detail. But yeah, there are lots of regulations around it. A lot of people just skirt around the edges of it and do things, I think, fraudulently, but that's for you to dig into. And then tenants is a massive con, can be a massive con. You hear the horror stories of somebody booking an Airbnb, basically partying all night, absolutely trashing the place, causing antisocial behavior, breaking stuff, and that can be what you get from this type of strategy. Anything I've missed?
Yeah, I just actually wanted to share my experience with service accommodation. So when I was in and out of London a lot, I took on a flat in King's Cross. So it was like a rent-to-rent flat. The aim of the game was to Airbnb it when I'm not there, stay there when I am there. Having at this point we'd done HMOs, and like I couldn't get over that we didn't have to put any form of fire protection, any form of second fix items in the property to make sure that it was better improved for someone to rent that without having lived there before. Equally, no planning, and actually Camden Council were on the case. They used to have people out and about watching bookings go in because it had a lobby. They couldn't actually predict which flat that the people were going to, so they couldn't really slap me on the wrist per se. But I think the 90-day rule is something that's pretty dangerous. And also one thing that we haven't mentioned here is there's typical complexities to get over the VAT threshold, because you have to charge VAT on income if you're over the threshold. And a lot of people try and be clever and diversify into multiple different businesses, but there's no degree of separation there. That's just avoiding tax. So just basically planning, fire and safety, finance, and then tax, like all of them are like grey. Like I just don't get it. I think it's I think it's a quick win. Next, I think it's social housing.
Yep.
Cool. So just trying to speak a bit of Japanese then. So social housing. There we go. Got it out. We built over £25 million worth of social housing stock in South London. We've kept the majority of that. And we're going to go through the pros and cons. So the pros is typically government supported income. And what I mean by that is it's typically paid via channels. How we do it with social supported living with a registered housing association is typically drawn through universal credit. So the income is deemed more secure than like a private rent. The demand is high. Like the housing crisis that we have in the UK is not just for privileged people, but also people that are not as privileged or even vulnerable. So there's the list is crazy long. So yeah, it's a huge demand. Typically low management if you have a good management operator and tenant in situ. Cons, and we felt this, the yield valuation shot and changed very quickly on us. It's recovered and recovering. It's not quite back to where it was, but it's recovering quite strongly now. But we saw within a year period, the yield drifted about 25% in value. You wouldn't see that in the residential private market, and it's because the yield markets operate differently. They're more cyclical. They have other factors that push them. And we definitely felt that hit, but we held on. And in those situations when you see, I wouldn't be surprised if that was one of the peak and the troughs of the decade, and we saw it within the space of a few months as a gap, which was crazy. So you're definitely vulnerable to yield value sensitivity. Lower rents in the open market, it isn't as cash strong, but you sort of swap out cash flow for security, similar to buy-to-lets. And there is potential for overvaluations as well. But generally speaking, one thing I would say is the social housing sector is a very difficult one to navigate. I was speaking to an investor and I was sort of saying there's a lot of bad players in that space and there's a lot of good players, and it's probably the most diverse in terms of that respect. And you do have to be careful with some people that are only in it for the money. We've always prioritized the tenant's care because it's a self-profiteering cycle. If the tenant isn't getting the care they need, they can't typically stay on benefit and sort of recover from whatever possession they're in or what transition housing they're in. And then it sort of trickles back and feeds back round. So we've always focused on tenant care and product first. There's other people that focus on cash first. So I'd also say a big con is there's a few ropey people in the industry not doing it quite correctly. What are we on next? Buy-to-lets?
Buy-to-lets, yeah. Cool. Sorry, just fiddling around. Cool. Buy-to-lets, the basic, the OG, I guess, of property strategies. How I got started in property 15 years ago. And there's a lot to be said for this, and I think I'll go through them. But the pros of buy-to-lets: steady income. It's nothing clever. It is buying something, renting it out, and sitting on it, and that's really it. There's nothing too intensive around it. That's another pro for buy-to-lets. It doesn't really occupy too much of your time once it's let. You might have a bit to do in between tenancies, but if you've got a managing agent, taking 10% of your rent roll to manage new tenants and oversee that process, then again, should be relatively hands off. There's always going to be good demand in most areas that you're in. The rental market is piping hot, has been for ages, because there is shortage of rental property. So you shouldn't really have any issues with renting your properties out. You obviously 5 years ago, no, it's more than that now, wasn't it? Maybe 2000, whenever they brought in Section 24 tax.
I think it
ultimately
was
before then. When was it? 2018. Anyway, before they brought that tax, those tax issues in, obviously holding buy-to-let in your personal name was what most people did. They brought in the tax, and higher rate taxpayers, if you own properties in your personal name, you get absolutely smashed in terms of tax. Yeah, in terms of tax, if you are in that high rate tax bracket. Things have changed. Most people now buy things in limited company structures. Obviously, you speak to your own accountant. Your own needs are slightly different. This is not tax advice. But most of the time nowadays, people will buy buy-to-let properties in a limited company structure because it's way more flexible, way more tax efficient, and all those other good things. And it's generally not so capital intensive. You might have to give a property a lick of paint or refurbish, or do what you need to do to get it to a position where it's able to be rented, and you might not even have to furnish it. With buy-to-lets, it's a lot of, I don't know what the split is in terms of furnished versus unfurnished, but there'll be a lot of furnished. What is it?
Most would be unfurnished.
Yeah, so that does surprise me a bit. I think that's probably maybe changed over the last couple of years. But yeah, most are unfurnished lets. So people buy it, make it their own, bring their own furniture, which hopefully means they're going to stay for a long time, and that's that's great. The cons of it, the returns on a single buy to let can, certainly in the southeast, you can struggle to make good money on a single buy to let. It's way more restrictive in that respect. You're not going to get massive high yields. If you're renting out and getting a 6% gross yield and your mortgage rates are 5%, maybe 6%, then you're going to struggle to make money, especially if you've got it in your personal name and you're paying tax on that. And that's why ultimately a lot of landlords are leaving the market. So I guess one of the pros that's missing from that list is now is a great time to pick up stock from tired landlords, from portfolios that are in that space. Give it to somebody that's got a bit of vavavoom, to an energy to put it, and capital to put into it, to refurbish it, to reconfigure it, to then increase the rent and do something else with it. So yeah, opportunities there. Personal ownership I've mentioned, and from a compounding perspective, because it's low return, you're in the south, hoping that you've got some capital appreciation aligned with that. Up north, you're going to get higher yields, but fundamentally, if something goes wrong and your boiler breaks, you could have a year's worth of income, go on just repairing that boiler, because the actual value of the rental income there is so low compared to what it is down in the southeast. Season 2, episode 6, we did a session on this, buy to let products, how to decide, on what debt products to go with. That's probably going to be a little bit outdated now, but fundamentally, I'm sure there's still some nuggets in there. So season 2, episode 6, talking about buy to lets. Cool. Land promotion. Do you want me to do this one?
Promo. Yes, this is more tradery, and I know a few people that secure land up on options, get the consents, then trade it out. And it's slightly different to building out, larger schemes, because there's successful land promoters out there and people that take the sites through the planning. So going through the pros, the time to unlock these sites can take forever. You might be aggregating land, you might be dealing with a farmer, you might be taking out bigger sites. So essentially, it can be quite a time-consuming process, and that's obviously one of the potential downsides. But equally, you can, as a time to unlock the value, you can, if you get something optioned up and get the consent on it, the turnaround of the cash back into your bank account, as opposed to delivery and sales risk, is quite quick. Lucrative uplift in planning. I think the best pound for pound uplift, time return uplift, is planning. Like if you can make percentages in development, you're making multiples in land and planning. So it's definitely the most lucrative part. But guess what? That comes with risk. So it's also probably a riskier side, because if you just have to deliver a house and build it, the risk is different if you have to get the consent for it. There's obviously a lot of moving factors that come into play for that. Huge upside for the landowners themselves to get, something agreed up from a promotion agreement, or whether it's a JV or they're getting a value bought off them. That £18 million site I mentioned earlier in the episode, that was a single lady that owned that as a horses field that walked away with 18 million quid. So they're very profitable for the landowners. From a cost perspective, is you typically don't have to buy the land up front, and you may actually never need to buy the land. You can typically back to back it or promo that agreement, or if you want to buy it, you can. So there's typical leaner costs to get in, but they are at risk. The cons, it can take a long time. If it's a big site, capex can be huge. One of our friends runs the Southern Division for a Scottish home builder. They spend about £1 million per planning application, which is crazy. So it can be cost effective. And then planning risk, evidently, if you don't get the planning, that's all down the pan. It's not an asset backed investment until you get the ticket for consent. So you're investing in something that might not be achieved in planning. So if you don't have the luck, the right team, the right site, you could lose all that money.
Nice. I'll let you do this one.
Cool. So now take that a layer further. we've got all these strategies that we've thrown out to you. And what I'd highly recommend is think, what do I want to achieve in my goals? What pays me better? What risk appetite do I want? Are you in 9 to 5 work? Service accommodation might not be for you, because you might need a slower burn income in respect to that. So what I've actually done here is I've merged strategies. So you're doing dual strategies under one roof. Actually, in one case, 3 strategies under one roof. And the reason I've done this is because in XP, we actually do aggregate different strategies all under one roof. So I believe service-based businesses can be aggregated with any of the strategies that we've discussed. Ideally, if it's complementary, maybe lean into ones that are more beneficial, such as there's a guy that lives in Handy who's a fire separation specialist. He can't really do a lot with buy-to-lets with his business. But if he went into developments, there would be cross pollination between fire breaking flats and his actual business being in fire breaking. So that's an example of a service-based business working alongside other businesses. Obviously, land promotion, land deals, and land options work really well with ground-up developments. I've put in here social housing and HMOs. We don't typically blend that as a strategy, but I know some landlords that have now got some private HMOs and some social housing like HMOs. Now more RBAG, commercial conversions. Some of our commercial conversions will end up being buy-to-lets or HMOs, cluster flats. So we actually do merge doing a commercial conversion and considering HMO exit within that commercial conversion, or buy-to-let, or obviously sell, or a mix of all 3, which is what we have done before. And then last but not least, if your background is in like lettings and property management, buy-to-lets and HMOs go really well together, because you're essentially just managing those properties. So you get, again, cross-pollination across the 2 businesses, and it's good to mix those strategies.
Nice. So, I mean, onto service-based businesses, like Jack says, we've had this conversation numerous times recently with almost all mentees that we've got, and anyone that will listen, basically, because, without our service-based businesses, property development is extremely lumpy. You've got 3 years potentially between seeing any money or any return from some of these projects. So having a service-based business alongside your property development and investment arm is, I think, an absolute fundamental thing that you need to think about. And if you can blend it into the development side of stuff, like the fire, the fire engineer that Jack's just mentioned, or architecture and XP surveys like we've done, where it's very clearly part of the ecosystem that all feeds into each other, then even better. The pros of this are, cash flow. Ultimately, like I said, property development is lumpy. So having service-based business that provide regular cash flow is brilliant. That cash flow is typically more consistent because you're not having those lumpy cycles. You've got an extended team that can help navigate your development stuff as well as your service-based businesses. You're basically calling upon not just the team that you've got, but the network and extended network of professionals and resources that are formed within those service-based businesses as well. The complementary side of stuff we've just mentioned, complementing the development and property business. The cons, it can take 3 to 5 years to grow a service-based business to achieve the things that I've just mentioned in the pros. It's not easy to set up a company, to set up a business, to run it to a point where you can free up yourself from that business. You can bring in a team to cater for the work and have it run itself whilst you focus on the property investment and development stuff. But ultimately, that's why we're here. This is what this podcast is all about, because it's something we've done with numerous businesses. We're actively doing it with others, and hopefully you can learn stuff through us and not make some of the mistakes that we've made and all that sort of stuff. So I guess the one of the cons that we mentioned there is market risk. If you do have an ecosystem that is very much tailored at the construction industry, for example, if it's been a shit time like it has for the last 18 months, then all of your businesses may get affected. So you'll also need to think about within those businesses ways in which you can expand and contract with market contractions, but also look at ways in which you can deliver or offer services that are maybe of use when things downturn, so that you can counteract those downswings with one of your businesses performing well, even if one of the other ones don't. Cool. Which brings me on to the property industry in general and professionalizing it. And if you didn't see my post on Instagram yesterday, go and take a look at it. And this is all about acronyms and terminology that you hear within the property industry. I've got Samuel Leeds up on screen. I've got Abby from, I can't remember what, Abby Holloway or whatever her name is. Steve Hamilton, BRR training course online. That says it all really. You've got other people's money, no money down, OPM, BRRR, power teams. That is the biggest bugbear that certainly Jack and I have. In the professional industry, this is bullshit. You can spot a newbie property investor and property developer from a mile away as soon as they start spouting these terms. It is not a professional term. You do not hear it in the professional industry when you come from a design, construction, architecture, engineering background. These are words that have been spun out of marketing, education platforms by the property gurus that are extremely good at marketing and not really very knowledgeable when it comes to property itself. So I guess it's just to say, think about what you're saying, think about the terminology you're using. Don't buy in or get sucked into this type of marketing terminology. When if you want to raise money, and we've raised over 17 million pounds in equity from partners over the last sort of 6 or 7 years. We've not done that by spouting acronyms that are irrelevant to the industry. We've done that because we are professionals. We talk a professional language. We understand the market. We understand the property industry from start to finish, and that's how we've been able to come across as knowledgeable, experts and credible people in the industry, rather than just trying to sell courses and make things look more simple than they are by giving them acronyms and simplifying the process to get you to basically pay money to learn more. So yeah, that was it really. Cool. And if you get value from this podcast, then please do rate us. It really does mean a lot if you can just click that subscribe button. If you haven't already and you are tuning in live, whether it's on Instagram, on YouTube, on Facebook, on LinkedIn, drop a click on the like button. And even better, tell us who you are, where you're from, and what you're doing in the property space, because that will help the algorithm go a little bit further. And for those that are tuning in on video format, thank you very much. That is definitely the best platform to look on. So head over to YouTube, make sure you subscribe to the Property Experts show. But we then repurpose these video podcasts into an audio format and release it every Monday at 5 a.m. for your listening pleasure on Spotify and Apple and all those good places. So yeah, rate us, review us, like us, comment us, subscribe to us, all that good stuff. Quickly on Aura Architecture, we are really hopeful that we can win a bit of work over the next sort of couple of weeks with some developers that have been tuning into us, a lot over the last couple of years, but we haven't had the pleasure of working with. And I mentioned probably about two months ago that it's been a difficult year, and I wanted to know why more people that tune into me regularly, to tune into XP, that follow Aura, don't use us more for their projects. And I'm really, really happy to say that, and big thank you really to those that have taken that on board and have asked us to quote for your projects. Whether or not we're working with you now or in the future, I really appreciate that for one. I know that I can add significant value to your projects, both from a value add perspective and a, cost saving and stopping you from making certain mistakes through the process. So, if you are a property investor, property developer, whether you're working on HMOs, commercial conversions, new builds, Aura Architecture are, my business is run by myself, who understands all of that property development life cycle from start to finish. We not only design, fantastic looking homes, but we are very, very commercial when it comes to making sure that you are maximizing gross development value, reducing build costs where you can, and also basically optimizing your bottom line and making you as much money as possible. So if you've got a project you want to discuss, please do reach out. One of the main reasons I wanted to bring this up today is that we've made the decision internally within Aura to effectively split out. We've talked about before rebranding, which we're sort of somewhat doing, but we are going to be splitting out the developer side of the business into its own sort of business function, which we've spoken about doing a lot before, and we are definitely going to be doing that over the next couple of weeks. So you will start to see a new Instagram handle specifically for developers. There will be no mix of kind of residential architecture and developers on the existing Instagram handle. We've got 2 YouTube channels. So we've got the Resi arm, which is the current one for Aura Homes, Aura Architecture, and there will be a new YouTube channel specifically for development walkthroughs, inside information around, you know, commercial conversions, how to optimize HMOs, etc. So when that's all live, you know, I would love for everyone to subscribe to that and give it some love to try and get some traction with that side of things as well. So yeah. Cool. If you want to grow your business, if you want financial clarity on you know, how your business is operating, you need Xero accounting software, and we have 90% off for 6 months via the link down below. So if you haven't, if you aren't managing your finances very well in your business, Xero will help you massively for something like $25 a month. You know, it is cheap as chips, and you will not regret it.
Cool. I'm happy to dive in on this one.
Mm-hmm.
So I talked about, a question was actually asked at the Ground Up event about how we structure things with investors. And it's fairly straightforward. And I just thought we would talk through the exact structure. And we actually do this with HMOs, flips, and also development. So very, very similar structure. There's typically 2 different ways that an investor can come in on a project. They either go the equity structure route, which is where you're sort of JVing, as it were, or they come down the debt route where you are still the sole responsible person for delivery and the capital is accruing interest regardless of the success, highs or lows of the project. So the top structure, if you're viewing, but for listeners, is where it's just the investor has a limited company, you have a limited company, you set up a special purchase vehicle, you deliver the projects in that special purchase vehicle, their loan comes into that SPV, typically secured on a second charge. We will always offer a second charge if it's available. Shouldn't be any reason why it isn't, which sits behind the first charge lender, which is development lender or bridging lender, depending on how you're buying the site. And that loan typically doesn't accrue any interest, but they get 50% of the proceeds of well, ups and downs of whatever happens at the end of the project. So at the end of the project, the waterfall structure is bank get paid back through sales, then the investor's principal loan gets paid back, and then whatever's left in the tank is split accordingly to the structure. We quite like 50-50 because we think it's fair, it's down the middle. Obviously, if we put capital in, that changes. Obviously, if they put less capital in and someone else comes in, that might change, but we very rarely do anything with more than just one investor. And then the debt structure is where they typically don't take a shareholding in the SPV. They typically do still take a second charge, but they are fixed typically on a rate, so that rather than them riding the highs and lows of the project, they are typically getting a more predictable agreement up front. So it's then down to the developer to make sure the scheme's successful, services that interest, and also has a profit at the tail end. And we do this across all the boards, so HMOs, developments, etc. So I thought that'd be useful to share because I've had a lot of people. I actually had a guy from Dubai call me and ask me about this. So there you go. Now you've all got it. Have at it.
Nice. On that then, on Instagram earlier, Sunny Singh asked, can we discuss about loans? What loan types should be used? What kind of rates are right now available for developments? So on your point around kind of debt structures, what type of loan facilities are we seeing? What are people wanting? What are the structures that we normally look at?
So did you ask me a question?
I can see you typing away. Yeah. So Sunny Singh has asked basically what type of loan investments do we use? What kind of rates are we giving nowadays? You know, what type of security for rates? You know, very quickly sort of talk about that debt structure.
For investor loans, I mean, it completely varies. And actually, the more important thing is we always ask the question, what does the investor want for them? And then we can kind of see whether it caters to fit for us. We're not driven necessarily solely by rate. We like working with process. If we've got a planning deal, you know, I wouldn't expect to pay 8% on that because it's higher risk. So the risk rate would be higher. Typical mezz lending, which is a comparable product to second charge investor lending, is around about 18%. Typical first charge lending is blending around 10%. Sort of anywhere in between that is an expected rate for a second charge investor. We've got some lower than that just like working with us. So yeah, it's across the board, and it all depends on what that individual wants as a return on their capital.
Nice.
Cool.
Very quickly, we put this in earlier, refinancing finally on Long Hanborough. This is our doctor's surgery conversion to 5 flats, which is effectively a 14-bed HMO. Season 2, episode 4, we talked about, whether we completed on this. Season 2, episode 35, we did a deep dive on this project. So if you want to know more about how we secured that, how we funded it, what we delivered, what the build costs were, season 2, episode 35 is a great episode to really get into the detail and nitty gritty around one of our projects. We like to do these deep dives every now and again, and that's the episode to watch for that. Did we refinance eventually? I haven't checked my emails.
We did, yeah.
We did. Perfect. Good. So yeah,
the investor just said, I said, I'm pretty sure it's done. He said, hey, yeah, saw. And then he said, they generally don't reply to me talking about the lawyers.
Right. Nice. Standard. Cool. But yeah,
sure
refinance, that was a real pig. I mean, maybe we'll go into the detail of that another time, but it's been a long time coming. It's taken way too long. It's cost way too much. But that seems to be the case nowadays with property development in general. But we'll go into that in more detail at a later date. Cool. And I'm heading out to Dubai. So I'm literally just in the background, kind of typing a message to somebody on Instagram, try and book in an evening dinner with them out in Dubai. I've got the 4th and the 5th of February, Wednesday, Thursday, free from the family to focus on business. I'll be at the Prop Tech event on the Wednesday. I've got various meetings all over the place in the evenings and during the day. If you're out there, if you're interested in UK real estate, if you're interested in investing in UK real estate, I'd like, or know anyone that does really, if you know anyone that you can introduce me to that would be interested in having a chat and working with award-winning developers back in the UK like us, then I would absolutely love to have a conversation. So drop me a DM. I'll be out there all week, but 4th and 5th of February is when I will be on business. Cool. I think unless you want to go through, did you see this question?
I'm very short of time today, but I did actually get a question directly to me, which I can quickly answer.
Cool.
So someone said, it's actually Stephanos. Question for live, if you're short on them, might be interesting for the viewers. Why don't you use crowdfunding for your deals in any format? And it's a really good question because the first deal we ever did, we actually crowdfunded. And the main reason that we don't use crowdfunding is because by the time we've got something agreed and under offer, we don't typically have the lead up time to capital raise through that process. And actually, it doesn't look great if you're agreed something in legals, then online you're capital raising for a deal and it's sort of incrementally going up. So I think it works really well on deals that are given and are guaranteed to be secured, but it's quite risky if it's an on-market deal that you need to act quickly. So a lot of buildings that we buy is typically uncon, get in, get the deal done, and then we're off. So that sort of lag period of capital raising for our crowdfunding platform is one reason. Second reason, crowdfunding platforms charge 5% for the pleasure. So if you're paying someone 15% and they're charging 5%, your cost of capital is actually fairly high. And they also charge monitoring fees and reporting fees, etc. So we've had success raising money from high net worth individuals with one person. We actually really enjoy working with them. So why work with 100 if you can just have one? So that's our main two reasons, which I thought would be useful.
Nice. And Jace, I saw your question around Red Books. Thank you very much for tuning in, and also all the questions that have come through over the last couple of weeks. It's been really great, and we'll come on to that one next week. You've also asked this week, would development deal sourcing be a good service-based business? Potentially, maybe we can answer that next week. And Andrew, thank you very much for your question earlier. At what stage would you instruct a QS to check if your build cost assumptions were correct? Would this be after offer accepted but pre-exchange? And we will answer that next week as well. So for now, thank you very much for tuning in this week. Don't forget to like, comment, share, do all that good stuff to help us out. That would be amazing. And until next week, we hope that you have a fantastic weekend.